All right, let's dive into the world of gold. We're looking at the latest gold demand trends report for the second quarter of 2025. And honestly, behind the big headline numbers, there's a fascinating story playing out. It's really a tale of two completely different worlds pulling the market in opposite directions. So let's get right into it. Okay, let's just kick things off with the headline number, 132 billion US dollars. That is the total value of gold that was in demand in just the last 3 months. It's a 45% jump from last year, which is, absolutely a record-breaking figure.
But here's where it gets really interesting. That huge surge in spending, it happened even though the actual amount of gold demanded, I'm talking about the physical tonnage, only went up by a pretty modest 3%. So what does that tell you? It tells you the story of this quarter is all about one thing: price. The record high price of gold is what's inflating the value of the market so dramatically.
And that right there is the central puzzle we're going to unpack. With prices this high, who's still jumping in and buying more, and who's getting priced out and taking a step back? The answer shows this deep split in the market.
So let's start with the group that's driving this whole thing. The first part of our story is all about the investors. They are, without a doubt, the engine behind this entire record-breaking quarter.
I mean, just look at this. Investment demand shot up by 78% compared to this time last year. That is not just growth, that's an explosion. This is exactly what's fueling all that record spending we just talked about.
So why the sudden gold rush? Well, the report points to what's pretty much a perfect storm of factors. You've got ongoing geopolitical turbulence, a ton of uncertainty around global trade, and right in the middle of all that, you have gold's timeless appeal as a safe place to put your money. And on top of it all, the price momentum itself just pulled in more buyers, creating this really powerful feedback loop.
And it wasn't just one kind of investment either. The demand for gold-backed ETFs, the funds that let you invest in gold without having to actually store the bars under your bed, was massive. And at the same time, people buying physical bars and coins were also incredibly active. You put those together, and gold had its strongest first half for investment in more than a decade.
Okay, so that's the investors. But now let's flip the coin and look at the other side of the story. While investors were rushing in, regular consumers, especially people buying jewelry, had a totally different reaction to these sky-high prices. This is what we're calling the jewelry paradox.
And here's that paradox in black and white. The actual amount of gold jewelry people bought by weight, it fell 14%. It's almost back to pandemic-era lows. But, and this is the crazy part, the total amount of money spent on that jewelry went up by 21%. So think about that. People are buying less gold, but they're spending more money.
The World Gold Council, who put out this report, they put it perfectly. They called it a decoupling between consumption volumes and value. It's just a really clear sign that these record prices are hitting people's wallets hard, and it's fundamentally changing how they buy.
And this wasn't some small trend. It was global, and it was led by the absolute giants of the jewelry world. In China, volume dropped 20%. In India, it fell 17%. The combined market share for these two heavyweights actually hit a 5-year low, as everyday consumers just had to step back.
So, we have investors pouring in, consumers pulling back. But what about the third major player in the gold market, the world's central banks? Where do they stand?
Well, they kept right on buying. Central banks added a net 166 tons of gold to their reserves this quarter. So, yeah, the pace might have slowed down a tiny bit, but they are still a powerful, steady force in this market.
And if you zoom out and look at the entire first half of 2025, that number grows to a massive 415 tons. So the key point here is that despite a little slowdown in Q2, the big picture is that these banks are still very significant, very strategic buyers of gold.
See, for central banks, this isn't about trying to time the market or make a quick buck. This is all about long-term strategy. They see gold as a critical asset for diversification, a source of stability in a world that feels pretty uncertain, both economically and geopolitically. That core belief hasn't changed at all.
So, where does all this leave us? With these huge forces pulling the market in totally different directions, what's the outlook for the rest of the year?
Well, it pretty much boils down to these key dynamics. Investment demand, that's expected to stay strong. Central bank buying, that should stay healthy too. On the other hand, jewelry demand will probably stay pretty quiet as long as prices are this high. Oh, and on the supply side, we could even see record amounts of gold coming out of the mines.
And that kind of leaves us with one final big thought to chew on.
What we're seeing is gold really cementing its role as a kind of financial fortress for big investors and for governments. But at the exact same time, those same high prices are pushing it further and further away from the average person. So the real question is, as gold becomes a fortress for the few, is it moving out of reach for the many? Something to think about. Thanks for joining me.